Well, the market sure responded well after hearing Powell talk, suggesting that the tightening cycle will not be as aggressive as many people and traders believed since the launch of the FOMC minutes. Now, tomorrow, we got to heavily focus on that CPI data. That can really shake things up. This is the Bureau of Labor Statistics. They're going to be releasing that consumer price index. The forecast is at 7.0. A hot CPI report, if it comes in higher than forecast, that could potentially make the Federal Reserve act more quickly, more forcefully to potentially do something about the rising inflation, which the market could then interpret that as pricing in more rate hikes this year, and that could potentially create more volatility and shake in the market. The CPI forecast is 7% for the year over year. For the year over year core, it is forecasting 5.4. So those are the levels that we have to watch. Are they going to come in under? There are some macro thinkers that do believe that we're going to come in to forecast or slightly under and not actually start accelerating. A lot of people are believing that inflation is actually settling down. We will see. You're watching the Stock Market Brief Show. My name is Michael Silva. Today's January 11th. We got a few things to talk about today. I want to talk about the stock market bounce that's been taking place and look at some key levels and also what the options market is pricing in as far as volatility goes coming in to just tomorrow. Let's get into today's episode. Alrighty, welcome back. We are looking at the 10-year yield. Why are we looking at this? Well, we've been keeping an eye on it because of this explosive rate of change that it's been firing off on all cylinders, which really put a lot of pressure on mega cap growth stocks, the FANG stocks, the ARK fund, etc. And we've been looking to see it bump its head a little bit into resistance and pull off. Today, pulled off a little bit, down almost around 2%. And you can see here that actually did help continue that fuel of that growth rally. Now, when this backs off, TLT, we're looking at the iShares 20 plus Treasury bond ETF bounced up today, up 0.67%. So we're coming off of this, area of support from this range. I'm in a trade right now. I'm just looking to get into the middle range or around there for potentially taking profits. So if the 10-year yield comes off, we might see this continue its move to the upside, but then also we can see growth start to perform as well. So growth would be still a very key indice to look at. And we'll look at what the options market's pricing in here very soon. Let's take a look at IWF over IWD. This is just a way to look at growth over value. And you can see here, we started to turn up. Why did we start to turn up? Well, the 10-year yield started to head down, which that makes growth start to outperform value, which we've been talking about these past couple of episodes. We've been talking about how this has been overextended. Now it's starting to curl up. So maybe perhaps the rate of change is going to start moving itself to the upside, which can help potentially see a little bit more movement in growth from a relative basis over value. That's something that I want to be keeping an eye on. If we take a look at the 11 sectors that make up the S&P 500, energy has just been in this monster move, and it has not slowed down yet, up 3%, 3.5% just for the day. You can see technology made its way up there too. And then you have more of the defensive names towards the bottom of the list for today. If you take a look over here, the NASDAQ 100 is the top performer. So you can see it really thrived in the environment where we had the dollar basically dropping, but we also had the 10-year yield coming off a little bit there too as well. Now, if we look at year-to-date performance, just look at this move so far, okay? These XLE and XLF. They typically, from a seasonality perspective, they actually do start off the years pretty strong. Looking back at history, I'll show you actually a chart here momentarily, but already up 14%. It's January 11th, and then financials is up 6%, and then towards the bottom we have XLK, which has been a laggard, and real estate. So you can see here when the yields rose like that incredibly, financials did really well. Financials and energy do move hand in hand, and then towards the bottom of the list, more rate sensitivity, right? Real estate and tech. So you got to wonder if the 10-year does start backing off and coming down, which we have important data coming out tomorrow, right? The CPI data is, so it could shake some things up here. So we're going to have to be very careful. All right, so if this starts backing off, you would think that from a year-to-date perspective, these would come in a little bit, start, backing off a little bit, and then the rate sensitivity ones as well will start moving up. So like XLK and potentially XLRE too. So those are a couple things that I'm looking at, but they're, on the a lot of people have been calling for a correction, but it really doesn't seem like the market's been correcting. It seems like a big rotation taking place. And it's been like that for the previous year too, so we'll see if that continues. Let's look at a seasonality chart here of energy. Actually, sorry, that's financials. Energy's right here. So you can see here, looking back, 20-year range, and this is the XLE Spider Fund, and we'll look at the absolute performance too, but just pay attention right here at the early beginning of the year. Whoa, my thing just glitched out. January, you typically get a spike up, and then it fades towards the end. So is that going to be the same thing that happens? I don't know, but it's something to just be aware of that, hey, around 10, 12 days in, which we're kind of around there, it kind of finds its peak and then starts to subtly pull back a little bit, and then in February it takes off again. And if that's the case, you actually really want to pay attention to some high flyer energy stocks, or potentially even an energy ETF like XLE or XOP or something like that. Because if it does start pulling in after already making a considerable run, what's that called? It's called a bull flag. So it runs up, maybe pulls down 50%, retraces 50% of the move, and then it takes off. So that is something that we're going to be really wanting to pay attention to in the energy sector coming up. If you look at the absolute performance, we had large range, and then it started slowing momentum, but it was still putting in these higher highs and higher lows. And then today, it was just an explosive move, which could be a capitulation type move. We'll see. You can see more volume came into it, which could signal capitulation, as well as RSI is getting pretty burnt. So at this point, I would imagine people, if we get a gap up tomorrow, would be selling into it. But we'll see here, because the CPI data that comes out, it could still continue to shake things up. But this is not something that you want to chase. Now, if you look at the XOP fund, I don't have that up, but the XOP fund actually looked more like this, and it came in and then flagged, and it just broke out now, coming into the previous high. So that one looked a lot better than XLE being at this extended range right now. And one of the big factors here is obviously oil, right? If you take a look at a chart of WTIC, this thing has just been on a constant tear up too, and it's coming into an area of resistance up here at 83 to 85. So you would think that if it comes up here after a very strong move, it's going to bump its head a little bit and potentially flag, pull back, reset, potentially consolidate, and that could obviously lead to energy sector slowing itself down a little bit. So we're not too far off there, in my opinion. If you take a look at financials, seasonality, very similar type situation, except it doesn't come right back to the lows. It actually starts going pretty low into the end of January. So you see a bump up, and then it closes pretty much around the low going into February, but then you see a little bit more of a pop there. And this is interesting because we already got this run up, all right, boom, run up in the financial sector. Actually, we'll just bring up the chart. There we go. Financial sector, boom, already big start to the year, okay? This candle right here was a bearish engulfing, and then now it's an inside trading candle. So now right now it's consolidating, going sideways. So if that's the case, if the seasonality holds up, it's basically suggesting that at some point it'll pull down and probably fill that gap, potentially head lower. But what's that? I mean, if it continues to go higher, that's going to be also, once again, a bull flag. So, financials could be a hot sector to keep an eye on too as well moving forward. So that's something that we need to pay attention to. But as it stands right now, it's already made a very aggressive move, not as aggressive as XLE. So if it continues to move up, it's going to get more crispy. It's not more crispy, more frothy, and you're not going to want to chase into stuff like that. You want to wait for consolidation. Now, if you take a look at the dollar today is still range bound. Boom, boom. It started breaking down, and that really did help out on the S&P 500. You can see when the dollar moved down, the S&P 500 is moving up, and that's a correlation that we've been watching. So if this continues to break down, perhaps that might help the S&P 500 reach a little bit higher. Now, this dollar move to the downside really did help gold. Gold was up 1.1% today, and the chart's looking better and better as time continues on. So it's going to be interesting to see how it reacts to the CPI data. It wasn't just gold that had a good move. Silver also had a good move, up 1.56%, as well as the miners. The miners were up 2%, and this is just looking at the GDX. So some good price action overall taking place in the markets. But let's hop into the markets. Let's hop into the indices. Okay, let's take a look at the SPY. So first and foremost, this right here is what the market's pricing in for tomorrow. And the reason why I'm saying just looking at it going to tomorrow, looking at a very liquid product going into tomorrow, is because tomorrow is the CPI data, right? And we just got to keep an eye on. So what's the market pricing in? Well, it's only pricing in a plus or minus 3.6 $3.69 move. So on a chart, it says basically we can come up to around this 475, or we can come right back down to 465, which is the 50-day moving average. So it's not that to me is not all too volatile, with the big report coming out. However, we'll get into the Qs here momentarily, and that range is significantly bigger. Same with small caps. Now let's take a look at the SPY on the 15-minute time frame. So we showed this yesterday as well, and we talked about it potentially coming up to the 5-day moving average, and it could wiggle around. Well, it wiggled around and then broke above it, so that's good to see that consolidation, and then we broke above it. I would still be keeping a close eye on this 471 range, because 471 is the 61.8 retracement level, and it's acted as resistance right here, and we still have a declining 5-day moving average, and we're getting a little overbought right here too as well. So if the CPI data comes in lower than expected, that can fuel this kind of just excessive rally, just melt up type move. And then we're continuing this just volatile chop where it's very hard to find positions. And what I mean by finding positions is, periods of consolidation where we can look for potential moves out of a pivot area. As it stands right now, it's just been going back and forth with wild swings. Now this could be potentially wedging, could be potentially forming a bear flag. And if you take a look at the VIX, you can see that the VIX here on the 30-minute time frame is also wedging to the downside, and we're still within this little tiny zone here, this blue horizontal line. It's acted as resistance, support, resistance, support, and now we're right back there just underneath it. Now, if I were to zoom in on the 15-minute time frame, you'll actually notice that the RSI is a positive divergence, but it's not here quite on the 30-period moving average, and the risk still remains to the upside on the VIX for this gap and this gap. And there's even a gap that's even higher than that, around 40 and 45. So, it's anybody's bet at this particular point in time. We're coming into that area where technically it's resistance, but if I can see that maybe the data, when it drops and the market opens, we'll see a little bit more volatility come here at the beginning of the day. Let's take a look at the Qs. Now, the Qs, much wider range, right? So 4.6 versus the S&P 500, and the S&P 500, mind you, is a more expensive product. So this is pricing in a $3.69 move, whereas the Qs, it's a less expensive product, right? And it's pricing in a larger move at 4.6. So it seems to me that there's going to be a lot of volatility in tech names. Now, that's interesting because if CPI, that's just telling me basically, okay, so where's the CPI data going to take us? If the market responds well, guess where we're coming? We're coming up right to around the 50-day, the 20-day moving average, right around that 390 marker, which happens to be the upper edge of the expected move of the weekly time frame that we've been talking about. Now, if it starts backing off, it come back down to that 100-day moving average, okay, which is right just above 380, 381, that kind of area. Okay, if we take a look at the other time frames, you can see here just a monster move too. And where did we land? Well, we landed right between the 38 and the 50% retracement level, and it's just doodling around. So it doesn't look too bad, right? If we start getting above this, I mean, I like how it's building out this kind of shoulder here, where potentially you can look at it as an inverse head and shoulders. It's a little bit too early to tell, but the RSI is not too far off from being overextended. This could be a potential bull flag forming where we break out and then we go into that, a higher space right there. Now, if I were to go back over here, it says 390 on the upper edge. So if we look at this, where does that take us? 390, 391. That's the 61.8% retracement level. So if we start, quick move up to the upside, I'd be looking to potentially pull a little bit off the table right there, or potentially look for an opportunity to see if there's weakness in certain time frames to potentially short. Okay, if we look at the BP NDX chart, we talked about the bullish divergence, and boom, we're starting to see that move up, and there's still a lot of room that it can actually go up higher, so that's always an opportunity there. If we take a look at the IWM is also pricing in a pretty decent size move, 2.57, and you can see here that can bring us to around 221, so that can bring us to these previous upper wicks right there, or potentially right back down to around 215. So, that's a pretty large range there too, coming in just to tomorrow. It's expecting, basically it's saying it's going to expire 70% of the time. It'll expire within this range. We'll see, because the market has been going a little bit overextended on both sides as of recent weeks. So we'll see here if we can, tag one of these ranges come tomorrow. All right, let's look at the IWM on the 15-minute time frame just to get a good idea of what's going on here. Okay, where do we close? We close right at that 5-day moving average. It's declining, all right? And it's already been a very aggressive move. This could be wedging, potentially a bear flag. So that's what we need to watch out for. If we get a big gap up and we're starting to come into these higher ranges, right? We talked about the range already. So where was that? Just 221. If you come over here and look at 221, where's that put us? Boom. It's confluence with the 61.8% retracement level, just about there. So if we do start rising up higher into this range, I'm telling you, that's probably the area, if you did find a long position, that'd be an area to start looking for potential short opportunities and or start to take profits, or you can just raise your stop losses because, like I said, the volatility is still here in the markets. It could very well come right all the way up, but just pay attention to where price comes from. Right now, it's been very hard to determine the market as it just does that time and time again. Let's take a look at crypto, and then we're going to wrap it up with a conclusion. Keep today's episode pretty short. Sailor to shift ratio starting to still turn up here. That positive divergence we talked about. Hammer candles forming nicely right there. That's a good sign. Let's look at the daily charts. The daily charts, it's still not above that 44,000. We need to get back above there. I think that if we do start getting above there, it's going to be around 46,000, which is going to be a declining 20-day moving average and previous support there in that range. So that would make sense to see it potentially pop into there, maybe take a little bit of a breather, and then we'll see here if we can actually get some continuation. Like I said, I would like to see the Sailor to shift ratio turn up through 0, have a week that closed there, and also this to cross up through that line too as well, which is the relative strength line. Let's hop in over to Ethereum. Ethereum up 5.16%. Very good day. Hammer candle still below that 200-day moving average, but it is sloping up, so that's a positive sign. So if we start moving up, I would start looking once again at these previous areas of support that we cracked down from and a declining 20-day moving average if you're trading in the short term. We got to see this turn up. We got to see the obviously Sailor to shift ratio continue to hold that too as well. And then that could be very positive. We actually talked about, various crypto equities yesterday, BITF, BTBT, MARA, quite a few of them, and a lot of those performed very well today as crypto started to turn up. So I can only imagine those will do a lot better in an environment where we have a lot more ideals working in our favor. All right, so let's just wrap this up. Okay, it's going to be interesting to see how the market responds to the CPI data. I can go back and forth with a bunch of narratives, but the best data is going to be how the market actually responds to all of it. Okay, how's the bond market going to respond? How is the dollar going to respond? How is the indices going to respond? So that's what we're going to watch out for coming into tomorrow. So you just understand there's going to be a lot of volatility, and typically what we've seen multiple times is you get a head shake move. So you get a very strong move in one direction and then it reverts itself. So you want to see the market kind of digest this data. All right. Overall, though, when you take a look at the weekly time frame, we're still within an uptrend. We're still within a bull market. Okay. So we have lows that are higher and we have highs that are higher. Okay. We're just now through this in a period where we're getting some pretty large range candles and a lot of volatility. So it makes trading obviously a lot more difficult, and not necessarily more difficult, but it just makes it an environment to be more tactical, would be the word. Now, one other chart that I want to just kind of call to attention that I've been finding interesting is the trend chart. I like to use for overextended either to the upside or the downside to let me know when price can get a little shaky. And we've been getting a pretty nice recovery here so far off this low, and the S&P 500 has been moving up quite nicely. The trend indicator is kind of just a high, lower high, and it's kind of rolling itself over here too as well. And I'm just paying very close attention because this looks like it could potentially start getting into the red zone, which could tell me and signal that there could be potential weakness up ahead. And that would make sense on a move that's so very strong right here. And where if we can go up a little bit higher, that's why I'm saying, watch that 61.8% retracement level on the 15-minute time frame, and those, the upper edge of the expected move that we were watching too. It kind of all lines up. And if this does turn down and we have those other signals, that to me says, okay, the chop isn't over, right? It's just continued chop, and you can see that. Now, if you're wondering what happens if this crosses down through red, look at these vertical lines on the screen, the red ones. You can see it crossed down through red here, and then we headed lower, crossed down to red, we headed lower. Here we spilled over, but then we recovered, and then we headed lower. Right here, crossed down through red, and you can see we actually went a little bit higher and then lower. Right here, we did sell off. Right here, We actually sold off right here too as well. So it's been pretty accurate in determining short-term volatility in the markets and potential weakness or strength, because I can look at both sides. But that's all I got for you on today's episode, everybody. Hope today helped out, and I will see you back here tomorrow.